Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT, and we're here in sunny Dubai for token 49. So you may have heard, this is the Perpetual episode. We are going to be interviewing a whole load of people, prominent figures in the crypto space. And today I've got Michael Ourabah here from BSO right now, and Darius Sit from QCP. Pleasure to have you on the show, guys.
Thank you very much. Pleasure to meet you guys.
So we're not going to keep you too long, otherwise you're going to be drenched in sweat because it's ridiculously hot out here.
I think that's an understatement.
Yeah. But why don't you give us a quick, in a nutshell, what you guys do at BSO and why you're so important to the crypto infrastructure?
Absolutely. So BSO is a global infrastructure telecom provider. I founded the company back in 2004. So I've been in business for over 21 years and we shifted into the crypto space, having served the TradFi markets for over 21 years now. What we do is we basically build the lowest latency and shortest fiber distance network and microwave using RF technologies between the data centers where a matching engine or a liquidity venue, whether it's Darpool or OTC, is located anywhere in the world. So the objective is to ensure that any trading firms, market maker, HFT, algo traders, banks, broker, execution partner, anybody in the ecosystem can execute source data and make a trading decision somewhere else in the world as efficient as possible and with least friction that can be on the whole infrastructure stack.
And your client base is all the big, like hedge funds and market makers, liquidity providers.
Yeah, you're absolutely right. So all these big hedge funds, it's a part of the business. These are the most sensitive to the latency. But it kind of really goes all the way up the stack of market data providers, whether the very systemic one that sells to retail or small prop shops or small hedge funds or small wealth management firms, all the way up to tier one banks, the big names that do both retail and IB and
And so, I mean, the speed factor is very much like high frequency traders, or that is the main edge that they have, right? Being able to transact quickly.
So yeah, the high frequency traders are going to use the latency as a tool to arbitrage information that's gathered from many sources worldwide.
Yeah.
And then make a trade decision and execution. So the way they do it, they consume the data from a source, from an exchange like a CME or something. They're going to take the data, remove everything that's not important through their feed handlers, and then send to the other remote trading matches, signaling messaging as fast as possible on a bit-by-bit basis using our network and their specific FPGAs and devices to make this data seem as flawless as possible. If we take a look at how crypto functions, it's extremely different to TradFi, because TradFi is all around physical data center. The regulators are saying fair and equal. Everybody needs to have the same distance from the matching engine and this data to where they consume it. Where crypto, it's all in the public cloud. And the public cloud, by essence, is everything but determinism. So
you're saying that's because it's such a global market and so fragmented all over the place. It's not like in the US exchanges, you just need to be as close to the exchange as possible physically. Like people who are trading this stuff high frequency in crypto are anywhere in the world and they're doing it all through the cloud.
So not really. The matching engines of the crypto exchanges are inside the cloud, which means that the way the public cloud provider like AWS have structured the zones. Let's take any crypto exchange. They're going to be, for example, in a Tokyo zone. But the public cloud zone is physically split between 24 data centers in the Tokyo area, which are sometimes spread more than 120 kilometers apart. So this layer of abstraction that they create by putting that intelligent software, ensuring that any traffic reaches where the matching engine is located, this thing is composed of thousands of network and devices that are creating this lack of determinism. And what we're here to basically decipher and reverse engineer how they compose and build this layer of abstraction to give some sense of determinism between the edges of the public cloud into regions, and then use our network deterministically between the two, plus enhance this, non-deterministic piece through script and automation that we've developed and coded over the years.
And do you have like a fixed bandwidth that you have to sell effectively to your clients, or is it kind of unlimited?
We at the end of the day, technology allows us to use a single pair of optical fiber and demultiplex as much bandwidth as we want. So if a customer is a small prop shop of 2-3 people running out of India and want to trade in the Golden Triangle in Asia, Hong Kong, Singapore, Tokyo, they're going to buy 50 megabits, which is a small chunk.
Right.
It's not
And they don't get outbid by like the big market makers out there who are loads of money.
Not
like that.
They got more bandwidth, but because the guys that have got more money are more sophisticated and have improved so many different pieces down the technical stack, from the data to execution to algo.
So bits that you're not
Yeah.
providing, but they can do to
Correct.
make themselves more effective.
You're absolutely right.
Okay.
We level the playing field when it comes to providing the infrastructure from a network perspective, and add their own secrets. But all the HFTs, and I'm sure you can comment on that. all the clever things is inside. Of course, the quantitative strategies, the algos that they write, the trading strategies based upon metrics they source in the markets and signals. But how efficient and optimized the code is, how efficient the stack is when it comes to signaling messaging.
What percentage of the flow is done now by high frequency, do you reckon? Any idea?
I think we're close to 80 or 90% of the flows.
Wow.
In crypto?
No, I mean in markets.
In markets,
Okay. I mean, TradFi even more.
yeah.
But in crypto, I mean, I think it's split differently, right? I think a lot. I mean, and of course, you got the top tokens, and you got all the myriads of thousands of shitcoins who trades on dexes only, and these ones that's very retail based. It's very on-chain stuff on dexes, and it's a different type. But I think looking at institutional grades exchanges like Deribit, I think a lot of the traffic comes from institutional trading firms. I'm saying HFTs, but I'm putting the different feeds of the trading firm.
Okay, the demand of execution
Same buckets
capability.
versus somebody that's clicking on an app or
Like me.
or web interface.
On my phone.
But then you might even playing field for crypto. I mean, it's
It is. I agree with you. It's the skew is not there to the point, and actually it's this lack of determinism that gives a chance to retail and a home trader to compete with big trading firms that are professional and sort of institutionally organized in a crypto world.
interesting.
Amazing. So let's move on to you, Darius. I've been dying to talk to you for a while because I've been in the crypto options space since 2020 now, and you are a pioneer in the space. So you used to be at GS trading equity derivatives, right?
I used to be at BMP trading.
Why do I think you're at GS? Okay, I seem to remember.
Probably a GS guy. I was at BMP in trading in Singapore and then New York.
Okay.
Trading Asia FX and rates.
Okay. So yeah, tell us. Like, I mean, you've been in the space for a long time, right? I mean, a few things that stand out to me right now are looking across cross asset class. That's what we do at Options Insight, right? We look at all asset classes. Crypto vol seem to be very cheap relative to everything else, right? Like, you got everything else trading in the 90th percentile because Trump is kicking off trade wars and the world's worried about recession and we've got stagflation coming and all these things.
There we go.
And then you've got crypto vol trading near the lows, like 40 vol in the front or something.
Yep.
What's going on? Who's the massive seller that's suppressing this vol? Well, why is this the case?
I think it's partly a function of realized vol as well. I mean, it's for all the vol traders, we were expecting it to go to 90 percentile. But it's been a bit disappointing. I think good and bad, right? I mean, good thing is that, in spite of all the chaos, Bitcoin is showing to be pretty resilient.
Yeah.
That's one of the reasons. ETH is almost like a stable coin. So that's a good thing. It's showing resilience as an asset class. But of course, for vol traders, we're not seeing that much going on, and that's been disappointing. So I think, good and bad. I think, Bitcoin or crypto as an asset class has matured a little bit, and the vols reflect this. When I first started, I mean, the reason why we got into the first place, right? We were a spot desk. We were looking to hedge our downside, and I was like, let's go and buy some puts. I went on to Deribit, which at 2017-18 was the only a game in town, and the vols were 200, and I'm like, what is this?
So instead of buying your
you sell them, exactly. That's how we got started.
Doubled up the position.
But yeah, exactly. But these days, you have that a lot more efficient. So I think, one of the ways, I mean, we were just on the Deribit boat 2 days ago with all the old market makers, exchanging war stories, and one of the guys was saying this, right? He said, Deribit used to be a candy shop for the market makers, and today is a dog meat shop. It's less sweet, but there's still something there. Yeah. I think the way we see it is, we're happy that the market is growing, maturing.
Yeah.
And there's a lot more there's a lot more to be done in terms of term structure, in terms of...
But the easy money's gone kind of thing.
Yeah, exactly. So I think where the opportunity comes is in the actual development of the market, right? Again, like longer term structure, exotics, and the overlaps with what we see in traditional markets.
You guys are quite busy in the structured products world, right?
Yes, we are. Yeah.
So what type of products are people playing, like, are putting on in structured products, and who are the types of clients who do that?
So the product suite is very similar to any private banking product suite. So, I think the big players a lot of them are still the speculators, high net worths, but we have starting to see a lot of institutional guys come in. A lot of miners are starting to pick this up as well. So again, miners makes absolute sense for them, right? Instead of selling spot, do an outright forward, do a decumulator. And the funny thing is a lot of miners do accumulators as well. So, in Asia, a lot of guys like the high yield products like fixed coupon notes, equity linked note type of stuff.
Are they all generally vol sellers, these things?
So I would say a good mix of both.
So it's two-way flow in that.
So I mean, like, for example, we helped one of the Japanese list coast, Meta Planet. They managed to outperform spot Bitcoin by doing ERKO calls and these kinds of structures, which gives them extra complexity on their long Bitcoin view.
Okay.
And these have worked out very well. So I think you get a nice mix of both. Guys who are systematically long Bitcoin looking for more complexity, guys who are looking to hedge will be long vol. And then you have the yield seekers, the typical private bank clients that they're looking for the 15, 20%, 25% yields, and this market affords them that.
Yeah, higher yield than T-bond.
Yeah. and then the last question I'd ask you before we let you go is, so in the TradFi world, the options positioning has become extremely dominant, right? In terms of the gamma on the S&P is what everyone wants to know, because they're like, if the street's long gamma, we're not going to realize, we're not going to move very much. If the street flips short gamma, the market's going to become more volatile. And finding that inflection point and being aware of where that is and where it's moving around is giving traders a massive edge, right? So companies have been formed on that, right?
Yep.
So I guess my question to you is, how far away are we from crypto options being a big enough part of the market that the gamma positioning is so relevant to price action and in actually determining where we may or may not go?
It's actually always been relevant. Actually, ironically, the smaller and earlier a market is, with less HFT guys in, the gamma is even more important, right? But this is usually anecdotal. So early days, just from seeing the flows, looking at the ticker tape, and knowing where the OTC guys have traded, anecdotally, these days we've had to upgrade the way we do this. Just no longer just from ABC guy traded this and therefore there's a huge strike there and it was gonna be sticky. These days we've had to make more sophisticated models to determine these are the 5 models we're looking at. Where's the gamma? Based on whoever else is trading, and the sophisticated guys are looking at that as well. So I think we're almost there, especially now. But it's interesting for crypto because you have a native market, you have an OTC market, you have IBIT options, you have other native guys besides Deribit. So I think it makes it a little more interesting, a little more flavor to it. But I think we are already there.
Okay.
But not in a way that you can sell this kind of data. But
zero is interesting. I think the perception is that it's not a big enough market yet, like for it to be that significant. But it's interesting that you think it is, and I guess it becomes a little bit self-fulfilling, right? When if we're all looking at these things in a way, then it acts to kind of respect some of those sort of levels and the stickiness around some of those.
No, I think the crypto option market is bigger than people think it is. Yeah, I mean you see on Deribit, and Deribit's sizable.
Yeah, it trades like tens of billions a week, right?
There's a lot of bilateral OTC trading going on. As a shareholder of Deribit, we were always asking the question, what does it take for the big banks to come in? And do this. Almost there. I think we're almost there.
Well, you think the regulatory changes coming out of the US is going to be the big change, yeah?
Yeah, exactly. And, these guys, we actively trade with a lot of these big banks, either bilaterally or settle on CME or IBIT options. So I think, the pieces are moving in place.
I can probably add a bit of interesting thing on that. We obviously talk to all the tier 1 banks as well.
Yeah.
And I've been trying to educate them for the last 8 years, providing them all their FX network trading, options trading, derivatives trading, equities trading, like everything here. I was like, guys, it's unbelievable. You're letting this whole crypto market on the side. And they're like, no, we can't. And we're starting to see finally in the last 12 to 18 months, serious traction, but it's all coming from these tier one systemic banks. And it's all coming and derived from the private bank division. So basically the HNWI and UHNWI customers are saying, that's enough. I want to buy crypto assets and you need to be the custodian for me. And I want my Lombard loan against that so I can do my other stuff and borrow against my crypto. That's it. So they're all coming and saying, okay, how can we do that? How can we do execution straight with a centralized exchange? Yeah, but DEX is too tough. We don't know what's the counterparty, compliance, KYC, AML, what are we going to do? So we're starting this conversation that we tried to have for 8 years. So I join you on that. I can see the traction coming to evidence institutional banks.
Exactly. To add to this, I think we've been seeing interest in Bitcoin-backed financing. So similar to what MicroStrategy did with
I think that's a big area.
bonds.
Yeah.
Right? Yeah. So we're seeing that in with physical Bitcoin as well. So you know what you have is you have 2, 3, 5-year options being traded because these bonds are like convertible.
Yeah.
In 5 years' time, you have a strike on the Bitcoin.
Yeah.
So this immediately pushes that curve out. So we start to see a lot more liquidity in the longer end as well.
Yeah, I mean, that's definitely something I've noticed, like my conversations like through FRNT with institutions, like they're just starting to see Bitcoin now as collateral, another asset class with all the opportunities. People seeing the advantages of it as collateral and to like sort of be lending against that, 24/7 liquidity, all these things. So yeah, there's definitely been a shift in sentiment and a demand. And we've always said, go back even a year or two ago, it was career risk to like try and build a business in this. If you were in a traditional business, now it feels like the career risk is not building in this space, right?
So I'll tell you two things that sort of comes up in conversations with a lot of the institutional guys, listed companies, banks. Number one, Bitcoin is actually the only finite commodity by design, right?
Yeah,
By design is finite. So they're like, a lot of these guys are like, what if one day we are, in 15 years time we start mining gold on the moon or something, right? I mean, it sounds a bit far out, but supply demand dynamics change and Bitcoin becomes the only finite one. So there's a bit of a tail risk if you are a commodity guy. And the second thing is that Bitcoin is actually really pristine collateral. So you think about financing physical gold versus Bitcoin. You look at the physical gold in the vault, you don't know how many loans have been taken on that. You don't know. You don't know whether it's gold sometimes, right? So but whereas Bitcoin is mobile, transferable, transparent, sits in the wallet.
It's liquid, right? You just trade at the weekends.
So I think the credit market gets rebuilt, right? In the wake of all, this sort of post-apocalyptic, post-22, the credit markets are dead. I think that picks up again, and options is going to be a very key part of that credit market picking up.
Of course, yeah.
No doubt, especially when you put it in context of the 4-year cycle of Bitcoin 4-year cycle before halving, and on top of that, the Bitcoin collateral lending was on chains and is slowly moving off chain with TradFi players that are starting to do these collateral lending, and I think the other way around is going to start to appear where real world assets from TradFi like Strike on SM 500 and whatnot are going to start to be available on chain from wallets that want to trade real world asset liquid financial instruments without having to be registered, KYC, then do all that stuff with a broker dealer. And I can see, I saw a few DeFi platforms doing that already, and there's more and more coming. I think that's going to be a really interesting aspect, and we're going to see more TradFi stuff coming to on-chain trading.
That's it. And you asked me why I'm always bullish, right?
No, but I think this is one great point, right? Because people don't realize how disruptive Deribit is. Not even from a technological standpoint, right? Just being able to do 24/7 markets, live margining, auto liquidation, and collateral in kind, right? Without the whole stop borrow levy.
Yeah.
Collateral in kind is something that just lowers margin cost tremendously.
Yeah.
So even though Deribit has a fee structure that scales with Bitcoin price, it's offset by the fact that you can put it collateral in time.
Yeah.
Attractive.
Guys, thank you so much for coming here, the sunny device. It's been a pleasure to meet both of you.
Likewise. Thank you, guys.
Hopefully, son, for the whole. And if you're ever in London, if you're ever in London,
they gave me flat out app.
if you're ever in London, we'd love to get you back in the studios.
Good stuff, guys.
It's all right.
Thank you.
Thanks a lot, guys.
Cheers.